Yo guys, welcome to a brand new video. In today's video we're going to be talking about options versus stocks and why I transitioned over from trading stocks to options. Now I had been trading stocks for about 6 months to a year, and then prior to that I was trading index funds as well for my long-term self-invested personal pension as well. So not really trading, but there was days where I kind of sold them and brought more because of they're free to buy and sell, and if they went up then I sold them. But then I transitioned into stocks, and now in my kind of later in my career, into trading, I've now matured and gone into trading options. And now you'll understand why I said matured in a little while. So before we actually kind of go on to options and describe what options are, before we get there, I want to actually give you a definition of what an option is and what it entails, because I don't want the information to be misconstrued, or I don't want you to kind of misconstrue what I say, because options trading, it is, like I say, we're talking about contracts and we're talking about terms and things that if you do misconstrue, then they can harm you. There's a lot of things to know, but once you know the intricacies or the small details, then everything else kind of fits in. So before we start talking about the strike price, the call, a put, time decay, fader, delta, all these like I say, intricacies about options, before we scare you with those, I don't want you to leave the video. So I'm just going to kind of break it down into kind of how I learned it and the easiest way for me to kind of I guess pass it on to someone else. So I have a couple sheets of notes that I'm just going to kind of read off and just look at. So I've wrote these down because I wanted to be precise and accurate, and I did not want to kind of unfold or give out wrong information. So before we move on, let's just try to define what a option is. So it's basically an agreement between the buyer and the seller, okay? And it gives the buyer the right but not the obligation, okay? It gives the seller the obligation. So if, for example, we go long, we want to buy a stock and we want the stock to go higher, okay, we're thinking it's going to increase, we'll buy a call, okay? So we will buy the call, and if the price of the call, okay, so the contract, let's say we buy a strike price, the strike price is the price of the stock, okay? Say if the strike price is 55, okay, and the stock's actually trading at $45. If the stock goes to 55, the seller will then have the obligation to sell those shares to us, those 100 shares, okay? So us as the buyer, we have the right to exercise that contract, and the seller has the obligation to actually sell those shares to us. So the strike price is basically, the strike price is the price that you are basically predetermining you're going to be buying at. So if the stock's at $40 and the strike price is 50, you are in a sense preparing to pay $50 for that stock in the future price. You don't normally, options traders very rarely actually exercise the contract. They very rarely exercise it and actually buy the shares, and the seller has to, sell the shares. It's normally you trade the premium. 80% of the options traders actually trade the premium. Now the premium is the price of the actual contract itself. So for example, you would have a strike price of, let's say, 55, and that contract would cost you, let's say, 55 cents, and you're buying 100 shares. So one contract allows you or gives you the power to control 100 shares. So you times the 100 by the premium, the price, which is 55 cents, let's say, would cost $55. So you're buying a contract for $55, and you're going to say, I will, I'm having you've got the right to buy those shares or to exercise that contract if the shares go to 55. However, if the stock is at $45 and then the stock goes to 50, your contract will become considerably more valuable. So you would actually sell that contract onto the market, and you would take the profit that way. So you'd be selling the premium. So as we said, one contract equals 100 shares. So when you're buying a contract, you'll see it in like 45 cents or $1 or $2, times that by 100, and you'll get the price of the contract. So for example, 46 cents, the contract will cost you $46, okay? Like I said, the premium is the price per contract, and the strike price is the price the price of the shares, okay? So the price you're actually paying for that share. So if the share is trading at $55 and you buy the strike price of 60, you're saying, I'm forecasting for the price to go up and I will buy those shares at 60. Like I said, normally you would sell the premium before it gets to 60. However, if you did want to exercise the contract and buy those shares at 60, then the seller would have the obligation to sell those to you, and you would be able to sell them onto the market for the $5 difference per 100 shares. Now we've spoken about the call and a put. So a call is going long. Going long means you are going to buy the shares or buy the stock with the shares, and you are hoping that the price is going to increase. Therefore, you sell the shares for the difference, and the difference in between is obviously your profit. If you buy the shares at 40 and they go to 45, you net the $5. Now a put is going short. So for example, you are going to short the stocks at 40 and then you buy them back at 35 to cover your position, netting $5 different. People always get they're always a little bit unsure when they say buy it back. So it's something I struggled with. So basically, to short a stock or a put, you would buy a put, so you buy it to open, so you're buying to open the position and you're selling to close the position. So you buy, let's say you buy a put for $40 and then you sell to close at, let's say, $35. Okay, so that's a put, which is basically meaning going short. So what are some of the benefits for actually trading options? Well, there's limited risk in the sense that you can only lose what you put in. So if you buy a contract for $46, you can only lose $46. Now, the incredible thing with this is if you buy a contract for, let's say, $45, you can control 100 shares of a company, which is basically a lot easier to control instead of having to put that money up front and buying 100 shares of a company. You're taking on less risk and you're getting, if anything, a lot more reward than you would if you bought the stock. If you bought 100 shares of Apple at $150, that would cost you $15,000. You could probably buy a contract with Apple or for Apple for about less than $2. So it'd cost you about $200 per contract instead of having to put $15,000 behind that, which is a lot of money to have, and also a lot less risk. If you buy a contract of Apple, which would cost you about $2 per contract, if that, you could probably get an in-the-money contract for about $1.50. You could then sell that contract, so for $1.50, it'd cost you $150. If Apple fell 10%, and you had that in the shares, if you had $15,000 worth of shares, you'd be down $1,500. Whereas with the contract, you're only going to lose what you put in, so you're not going to lose a great deal. Whereas in the shares, you have to put a lot of capital into it, which then kind of stops you using that money into other funds, into other investments. Whereas, like I say, on options are very cheap and you're in control of a lot of shares. Another great thing with trading options, I have traded on SureTrader and I traded on TradeNet. I've also traded on Clomex as well. All day trading stock charge tremendous amounts of money for buying and selling shares and actually having the platform. A lot of people think you can just trade stocks and shares and it's free. You have to pay at least $100 a month for a platform. The average buying and selling commissions for shares is around $5 to $7 per share. Per trade. So let's say $7 to buy and $7 to sell. That's $14. So if you put, let's say, $1,000 into a position, you need that to go up, 1 to 2% for you to actually clear your commissions before you're making money. With my Tastyworks account, which is my options trading account, there is no platform fee. So the platform's completely free, and my option per trade is $1. $1 per trade per option. Okay, and I only really trade 1 to 2 options. So maximum of $2 per trade, and it's free to close the trade. Okay, so very low cost, and people think you only need to trade penny stocks to make a lot of money. It sounds good, and it sounds like that's why people make a lot of money, because obviously these penny stocks go up 100%. They come back down. The thing is, with options, you're trading legit companies. We're trading the S&P 500, the top 500 performing companies in America. We're trading Apple, we're trading Facebook, we're trading Netflix, we're trading GE, all loads of well-known companies. These companies are not going to drop 20, 30, 40% in a day, and if they do, you're only putting in a small amount of money, so it's not like it's a huge issue. It's not like you're having 20 grand into the position and it drops 40% and you're down $8,000. Your contract's only going to cost you a maximum of $100. So you've got limited risk, and you're trading, well-established and legit companies who have been around a long time. You're not actually, when I was trading penny stocks, I never knew these companies, and I thought it was, I don't need to know the companies. But now when I'm trading options, I'm like, I'm glad I'm trading Facebook. I'm glad I'm trading Amazon. I'm glad I'm trading Netflix, because I know what these companies are doing. I know what, I know what their goals are. So I know if, for example, I'm going long or I'm going short, I can use support and resistance levels, and it's only a small gap. And because it's only a small gap, it affects my contracts only a small amount. Okay, so just to kind of conclude and come to the end and kind of put it all together. So basically, let's kind of just sum up what we've spoken about. So we've got the stock, we've got a stocks versus options. Okay, so why I've kind of gone to them or transitioned to them from shares, trading stocks. So like I say, a lot less riskier. Okay, a lot less capital required, and there is still that reward. Okay, and we are now trading actual, companies. So I feel like it's beneficial for me, and the costs are a lot less, a hell of a lot less, dramatically more, or drastically more or less, should I say. Now, let's just summarize. So the option, okay, gives the buyer the right and the seller the obligation. Okay, so it gives you the right to exercise your contract, but it also, well, if it gives you the right to exercise your contract, it gives the seller the obligation. So the seller, the people who are selling the contracts, because you can actually sell contracts as well, but that's another video. The seller has the obligation to now sell you those shares if you exercise the contract. But like I say, we normally trade the premium. Now the premium is the price per contract. So you buy, Apple at, let's say, a strike of 150, and it costs you $1.46. So that's $146 because the premium is the price of the contract, and then you have 100 shares per contract. So you times the 100 by the premium, and that gives you the actual price of the contract. Okay, and we have call and we have long. Call is to go long, which means for the stock to increase, so you're forecasting the stock's going to go up, and then put is in reverse. You're hoping the stock goes down, so you're shorting the stock. And then we have buy to open and sell to close. So you're buying to open the position. Okay, so even if you buy a put, even though the stock you're selling the stock short, you still have to buy the put to open the position, and then you sell the put to close the position. And we have, like I say, limited risk and then unlimited reward. Okay, and like I say, it's a lot less capital intense, purely because you can have 100 shares of Apple for a lot less than having to buy 100 shares of Apple with the actual full price. Commissions are a lot less, like I've already spoken about. So I would say that's going to be the end of the video. If there's anything I've missed, or if there's any questions you would like me to ask, leave them in the comment section below. If you thought the video was comprehensive and a good detailed kind of description of why I chose from trading, or why I switched from trading stocks to trading options, give it a thumbs up. If you haven't already subscribed to the channel, please do so. I won't be going anywhere. I will be continually uploading videos of my options trading. I am currently up $43 in the past 2 days on my option account. We are taking things slow. We are just going to be building the discipline, the consistency, and hopefully we can progress into a successful trader of some sort. So thank you for watching, guys, and I hope to see you in the many videos to come.